For months, a cheery consensus had taken hold on Wall Street that the Federal Reserve would swiftly ride to the rescue this year with a gratifying bounty of interest rate cuts. This cozy vision allowed traders and fund managers to bask in warm thoughts of an easy money environment replenishing markets after 2022's harsh tightening cycle. But such rosy forecasts have been abruptly mugged by reality. Like scorned dreamers awakening to a cold dawn, investors have been forced to discard their forgiving inflation assumptions and tortured rate cut scenarios. The culprits? Stubbornly elevated price data that have dashed hopes of a pearly path back to a low inflation realm. The once imagined corridor of multiple Fed rate reductions this year has narrowed to a remaining slim possibility of merely 1 or 2 token quarter-point movements. This rude reversal stands in stark contrast to the secular rapture that took hold early in 2023. Back in January's dreamy haze, blissed-out markets harbored visions of 6 or more rate cuts, bestowed by an obliging central bank. But this year's steady gush of hot inflation readings, culminating in yet another upside data surprise this week, has doused such inflationary bonfire reveries with freezing reality agua. The cruel realization has set in the Fed's so-called higher-for-longer mantra on rates is not only alive, but haunting like sauce-stained bedsheets after a rest of anti-inflationary slumber. The markets have just been way too optimistic around the prospect for rate cuts, confessed Greg Peters of PGIM Fixed Income, sounding like a #burnished youth finally glimpsing the faded #coastal vibes of an over-Instagrammed beach. They're behaving a little more rationally now than they were at the beginning of the year. Indeed, the mood is a whiplash from last December's eggnog-laden euphoria when the Fed issued its most full-throated pivot signals yet on backing off rate hikes. Those dovish coups set off a joyous higher-for-longer-is-dead celebration across risk assets. Stocks and bonds embraced, giddy at the prospect of rapidly loosening monetary policy replenishing liquidity streams. But that rapturous bonhomie dissipated quicker than A808 bounced out of a lo-fi beat. Instead, robust employment and resurgent inflationary pulses slayed the rate cut party. The majority of analysts have been wrong-footed on forecasting tumbling inflation and rates, admitted Anthony Todd of Aspect Capital. The narrative rupture has been as jarring as a bytecode interruption in machine learning's latest buzzword. Whereas traders began 2023 pricing in around 6 Fed rate cuts, that figure has plunged below the central bank's own revised down-plot projections issued back in December. Sloshing salt into inflationary wounds are the climbing costs of industrial metals and crude oil, with Brent prices topping $90 per barrel for the first time since October. It is very clear the narrative is changing, intoned Torsten Slok of Apollo. While not burying the rate cut story entirely, even hardened doves are reckoning with diminishing monetary loosening prospects. Persistent growth forces like J.P. Morgan's manufacturing indexes rising into expansion territory have injected more hawkish antibodies into bloodstreams. I still think the Fed wants to cut once at least this year, but they're in no rush to do it and they'll wait for more data to give them more visibility into inflation, said Ken Shinoda of Double Line, suppressing sadness over discarded visions of a joyride rate cut cycle. But the balloon's hot air has already escaped. Government bond yields have lifted sharply as dreams of rate cuts dissipate. Despite tight corporate credit spreads reflecting robust earnings, stock market's ecstatic levity is at risk as higher for longer sinks in. As Mark Dowding of RBC Blue Bay warned, it feels like we've had an easy run up, but the landscape is turning more challenging. For investors, the rude awakening from their carefree upbeat visions has been jarring, like stumbling out of a virtual reality pod into strip mall fluorescence. The cruelty of hard data has shattered their wistful reveries about cratering inflation and a gratuitous avalanche of monetary easing. No longer can portfolio managers laze about, sipping oat milk lattes and musing over tantalizing plots of plunging Fed funds rates. The class has been brutally dismissed, print of its more fanciful projections. As Greg Peters admitted, rosy forecasts of sweeping interest rate cuts have just been tossed out the window amid 2023's inflationary resurgence. The narrative reset has landed like doll, outputting a lovingly rendered still life rather than markets hoped for lurid dreamscape. European rate expectations have cratered alongside America's, with traders now projecting a mere 3 cuts from the ECB and 2 from the Bank of England this year, down from Glastonbury-like psychedelic visions of 6+ moves apiece. It is almost enough to retroactively lend grudging credence to Jay Powell's seeming party pooper persona last year when he crashed the plunge protection Frisco with higher for longer #nominomania. The Fed chair's stubborn anti-inflation hawkishness apparently wasn't mere sartorial bluster, but the grisly utterances of one prescient enough to discern reality's contours. For the unsung doves, life on the depressed other side of the rift hardly beckons. Slock rued the uncertainty about the narrative of where we're going in rates as the source of why things are so turbulent at the moment. The cozy consensus path from late 2022's ZIR peer annuity has devolved into a veritable Schrodinger's rate hike cycle, leaving traders vexed. Still, flickers of hopeful anesthesia linger amid the haze. James Peters labeled the stronger growth/higher inflation economic pulse not such a bad backdrop for corporate America. If you just forget everything else and focus on the fundamentals, I think the fundamental piece is quite good. But such intellectually contortive caveats illustrate the sheer cognitive dissonance set loose across money manager ranks. A delirious avoidance of anticipating higher borrowing costs has given way to blanched recognition that restrictive monetary policy is poised to linger, threatening earnings and risk assets. For now, stocks have managed to defy gravitational expectations, with the S&P 500 index up over 7% on the year. Ostensibly, ebullient equity investors have decoupled from bonds' more morose discounting of extended rate suppression. However, some killjoy buzzwords already SB Spartan warnings that animal spirits are outpacing economic realities. It feels like we've had an easy run-up, but the landscape is turning more challenging, RBC Bluebay's doubting cautioned, seeming to recognize that stocks' dissociative price track amid 2023's rocky transition from fantasy to fact may not persist. As memories of last year's market repricing pain still linger, a reckoning appears underway between sober hawkishness and the residual muscle memory of gamblers betting on the eternal January 2023 put of monetary deliverance. Queasy hangovers are a strangely bimodal phenomenon, corporeal and psychological. The queasiness whiting markets suggests at least a partial reconciliation with the surly bonds and their disinflationary, mais-non, reality. And the chalice runnething over with 2022's bitter hangover tonic, the harsh anti-inflationary regimen that wasn't a placebo after all. For checked-out revelers finally surfacing to cruel daylight, the reckoning hasn't been pretty. Hair of the dog fantasies about champagne anti-inflationary showers were swiftly doused with caustic pricing pressures and the cold reality of higher for longer monetary suppression tactics. Wistful visions dissipating, powdery dot plots whooshed up gilded nostrils like so much insulin.